Boeing was on my list for last week, and you can see it's doing what pretty much what I said it would do. I'm gonna bring my indicators up. I got just so I can see my moving averages. You can see we right up here at the 1618. Now the 1618 acted as resistance and it kind of peeled back some. Now we're in a range where, hey, we could get some sideways action and then maybe it'll go higher. I'm not really sure why if I think it'll go higher this week. That's why I actually let's look and see if we got no what earnings is January 29th. So that is we go to the option chain, that's right out here. So you basically can still trade these monthlies, right? What's on the table? If I wanted to trade Boeing, because it's going sideways a little, I like selling puts. I like playing this on the selling premium. You either can come out here and sell the 140. If you don't want to take a whole lot of risk, come outside of the expected move, sell the 140. Want to come a little closer, maybe sell the 145 strike. That's the 28 delta. Pick up about 320 $20 in credit, and and just sit with it. Or if you want to define the risk, I would probably, if I'm going to define the risk, sell the 150, buy the 145. And now you got a put spread. And you say, what? Why would you do that? Because I don't know if this is just, it could just go sideways. Like, let me pull up Tesla. Look what Tesla did when it hit the 1618, right? It just went sideways from actually gapped up higher and then came down and then went and sat on this line for, that's what, from November 11th to what? November 29th. So about 18 days, maybe that's about 3 trading weeks. It just sat in this range. I was pretty confident if you was watching the channel that it was going to break out, and it did. We're going to come back to Tesla. Let's go back to Boeing real quick. So I don't know how long it's going to sit sideways when you buy. Now, if you were to buy a call option, let's say you bought a call option out around 165 or 170, right? Trying to ping it. You did something like that, 160, maybe 160 or 165. Either one of these are within the expected move and you trying to ping it. You on the clock. Now for them two, let's say it does the same thing for 3 weeks. Just go sideways and down. You're gonna lose value in that call option. Now when it breaks up, you can get it back if it does that. I do think that it'll eventually make it up here, but I just don't know how long it'll take. When you sell options, you get paid for that time decay. When you buy them, it hurts you. You need it to move in your favor. So with that being said, the next level up is right up here around 168. And like I said, now if you're buying stock, you're just gonna have to sit with it. You could do a cover call, buy the stock. If you buy the stock, buy 100 shares maybe, or whatever, your pockets can handle, and then come right out here and maybe sell the 170 call. I probably would come outside one standard deviation, sell the 16 delta, and then collect here. And then you can sit with it. Basically, as it goes sideways, you can get paid on that call a little bit until it breaks up and goes higher.